Hello friends, Patrick here with another value-packed video, or at least I think so. In fact, I'm so convinced you're going to find value in this one and learn something that if you're unhappy with it, for one reason or another, just shoot me an email and I will give you a full refund, no questions asked. Now, kidding aside, I've made several videos in the past about warrants. Alright, so we talked about several important concepts like the leverage ratio, which is the number of warrants you can buy for the price of one share. This is especially useful when the market is going up and you want to maximize your returns by maximizing your exposure to these SPACs. But what about when the market turns and now it's either trending sideways or even coming down with a lot of these SPACs that have lost 50% of their value? Well, it doesn't matter with this strategy. I've boiled it down to the easiest, simplest, paint by numbers strategy, where do you guys think you can find a SPAC that's going to grow by 10% per year? Well, what if I told you that with that SPAC, you can make 150% or 300% returns? That sounds like pretty reasonable, right? Well, I'm going to show you exactly how in this video. All you have to do is answer 5 easy questions. If the SPAC matches these criteria that I'm going to show you, it's probably a winner and you're going to make money long term. Now, 300%, right, you're probably going to ask, well, is this a risky strategy? Like, no, we're not talking about YOLO options or buying companies that have no revenues and you pay $4 for the warrants or any of that bullshit. We're talking about one of the best risk versus reward strategies that I found in the stock market. I've done it twice so far with 2 different SPACs. I'm going to do it again in the future and maybe it's going to work for you. So now let's get into it. Alright guys, I'm going to show you the strategy and the different companies, but for you to understand the calculations and be able to replicate it yourself, because I'm only going to show you a couple of the companies, but there's plenty more out there if you want to go look for them. You have to understand the concept of intrinsic value versus extrinsic value. I'll go over this quickly. So these warrants have an exercisable price, most of them, of $11.50. That means you're going to be trading your warrants for shares at a cost of $11.50. Well, if the share price of the underlying asset, which is going to be the stock, is worth less than $11.50, you would actually lose money. That means that you have $0 in intrinsic value. That is the case whether the shares are at $5, $9, $11, you have 0 in intrinsic value. There's nothing covering your position, right? So it's the opposite if the share price is above $11.50. You might not break even, you might not make profit, but at least you would collect some of your investment back if you were to trade in your warrants and then sell the shares. All right, so let's say that you bought a warrant for $1 and now the share price is $12. Well, what you would do to calculate the intrinsic value is you would do $12 minus $11.50. That means you would have 50 cents in intrinsic value. And if you were to trade them now, you would collect 50 cents back. Now, what about the other 50 cents? Well, that is the extrinsic value. This is kind of the speculation premium. So if you look at the different SPACs out there, anything under $11.50, they're all at 0 intrinsic value. So how do you derive a value for them? Why is it that a company like GoEV that is at $8.95, the warrants are at $2.72, but this company that I don't really know, SVAC, is at $10, but the warrants are at $1.62, right? So those are values of extrinsic value. This is kind of the premium people are paying. Hey, I think in the next few years, it's going to go to this and that, and we're going to be willing to pay this amount for those warrants. There's no real way to calculate it. It's all based on hype, speculation, people's feelings. But when it comes to the warrants that are, when the share price is above $12.50, then we have an objective way to calculate the value of these warrants, right? So let's say that the share price is at $14. Well, you have $2.50 in intrinsic value. If you were to trade them now, you would collect $2.50. So then it's really easy to calculate a valuation for those warrants. Same, let's say that the share price is at $30. Well, then the objective value for the warrants would be $18.50. I hope that makes sense. Anytime the share price is under $11.50, right, that's where you can really abuse it because there's no real way for the market to determine what the value is. It's all about what people are willing to pay for it. That's what we're going to be abusing in a minute. All right, now that you understand extrinsic value, it is all going to make sense. We are going to look for companies where the warrants are mispriced compared to the rest of the market. So you have a lot of newbies that are going to focus on the same companies. They're going to bid them to $4. We're going to just ignore those. We're going to focus on companies that have been overlooked. It's not that they're bad companies. It's not they're not as hypey and everything, right? And that's exactly what we want right now. We want companies that are established, have products, revenues, and customers preferably, right? So you want to answer these 5 questions. Is it under $2.50? If yes, you're on the right track. So this is an arbitrary number. It can be $2.25, $2, $3. It depends on your risk tolerance and how much profit you're expecting. There is a huge difference between the cheap warrants and the more expensive warrants. The cheaper, the better. Like if it's around $1 to $1.50, you're going to make so much more profits than if it's at $2 and $2.50, right? Let alone $4 and $5, where the shares need to go to like $40, $50 for you to make the same amount of profits. Right, so is it an established company with revenues? So we're looking for companies that have the highest probability of being successful in the next 2 years. And if they already have products, revenues, and customers, it is a great sign. You want those companies. So do they have realistic projections? You'll have to look through the slide deck. Like, do you agree with them within 10, 20%? If yes, then you're on the right track. So I'm using ACAC Play Studios in this example. This company, I would have said yes to all 3 of them. But here's where you need to pay attention to. I'm not the first person to say buy cheap warrants, but no one is looking into the redemption clause. Right? So now it's getting more and more common for the sponsors to add a clause in the prospectus where even if the share price never gets to $18, they can still call the warrants due. And this is a problem for us because for this strategy, we're really looking to build that intrinsic value over time. So if we got the full 5 years, that would be ideal, right? So if they can call them due within 3 months, we're not going to get that full ramp up over the next couple of years. So I want you to look into if they have a redemption clause. So you want to look into the prospectus, and it's going to look something like this. Redemption of warrants when the price per Class A ordinary shares equal or exceeds $10. So right now, the SPACs aren't going up very rapidly. So let's say that in 3 months, the share price is still at, let's say, $11. Well, you don't want them to call the warrants due, right? We said that you would have 0 in intrinsic value at the time. What would happen is they would use this table and you would do redemption date 57 months, $11. You would get 0.277 shares per warrant that you have. So yeah, you would get a little profit, right? Because right now, the current price for this company is $160, and we just said you might get $277 worth of shares. So, you know, you would have a little bit of an upside, but nothing compared to if you held it for the full 5 years. All right, 5th question. Do you think it's going to make it to $15 within 5 years? I mean, we're not looking for a company that's skyrocketing in price or going to the moon here. This is very, very conservative. I mean, if you're a stock picker and you can't find a company that is going to go to $15 in 5 years starting at 10, I mean, we have a problem. This is less than 10% increase per year. So if you pick 5 companies, I would assume that you're going to pick at least a couple of them that are going to be somewhat successful. So if you answer yes to all 5 of these, you probably have a winner. So this is the numbers that it's going to look like, right? So current price for ACAC Play Studios is $160, break even $13.10. That means that anything above that is going to be profit, whether it takes 1 year, 2 years, 5 years. So if it makes it to $15, that means you have $3.50 in intrinsic value. That would be a 118% return. $18, that would be $6.50, and that would give you a 306% return on your investment. Now, if it just goes up 10% per year, well, that would give the company right now a value of $16.04 after 60 months, and that would be 183.79% return. That would be pretty damn good, right? A lot better than index fund investing or even dividend investing. Even if you reinvest your dividends for 5 years, you're not going to get 183%. But the problem with this one, Play Studios, is that they can call them due anytime. That's not what we want. If we look at some of the other ones, I'm going to give you another example. Fuse Money Lion. Right? It's not a company that I like the most, but if it wasn't for the fact that the redemptions were available under 18, this would be a great opportunity. $127 for the warrants. I mean, if it only makes it to $15, that means you get a 175% return on your investment. $411 if over the period of 5 years it makes it to $18. That would be wonderful. But sadly, they can call them due. So we're going to look for more companies. And of course, this is not a full list, and it's not like companies that I recommend necessarily. You have to do your own due diligence. I'm just giving you a starting point based on this framework. All right, so 2 companies where you would say yes to all of these is Black Sky and Indie Semiconductors. Let's look at what the numbers look like. All right, so under 250, established, realistic projections, no redemption, and I do think that both of them should make it to $15. All right, so there's no cap. Until they make it to $18, it can just keep going up over the next few years. They have a lot of time ahead of them. So current price, 174, so that means the break-even is 13.24. Anything above that is profit. So if it makes it to 15, that's a 101% return. 18, that would be 273% return. Then if it just goes up 10% per year, 172. For THBR, look at how there's a big difference. Just, what is it, 7, so that's what, 31 cents different in the warrants. And look at the return difference, 101% versus 69%, 273, 214. So that's why I'm saying the cheaper the warrants, the more returns you're going to get. There's a massive difference between like the cheaper warrants and the more expensive ones. So here's another one that doesn't work. 2 of them actually. Some of them, like I thought these would probably be fairly good if they actually were not able to be redeemed. But Payoneer and Apex Clearing, both of those companies I think are going to be successful in the future. But sadly, because of the redemption, it's not ideal for this strategy. But look at it, 206%, 345%. You know, so it is what it is. You can still buy into them. Doesn't mean that the warrants are bad. It just means that you might be called early. All right, so now 2 more that are going to be successful in my opinion. The first one is MUDs, Tops, and then as a bonus, a company that I've used, I've done this twice already. It's very successful with them, is Finance of America. They just merged recently. So if you look at MUDs, Tops, I think that it's going to be yes to all of them. 216, if it makes it to $15, that would be a 62% return. How long is that going to take? 1 year? 2 years? Probably less than that, maybe. Right? Well, then you would have $3.50 in intrinsic value. That would be 62% returns. That doesn't even include the extrinsic value on top of that. That is just like at $15, you can bank on this. This is almost profits that you can just take out anytime you want. And then 298% if it goes up to 10% per year. Now, Finance of America, this is a company that is actually not doing that well. They're under $10 right now. But the thing is that there is extrinsic value to it. It's never going to go to 0 because of that. Even companies like HOFV, Hall of Fame Village, even though the share price went to like $2, the warrants never went to 0. Right? So I still really strongly believe in this company. I've made 62% profits with this company, even though the share price has never gone above 10.23. Right? So yes to all of them. Right now they're at 125. If it just makes it to $15, this is a 180% return. $18, 420% return. And if it just goes up 10% per year, we're looking at 269% returns because they're not going to be calling the warrants due. So this is what I've been doing. I did this with Finance of America, extremely successful. Right? I sold warrants at 175, 192, and the last one at 132. Right? I exited my position. If it drops back to $1, I am going to load up on this one again, looking for these insane results. The company might not do anything for the next year or two, but within the next few years as they grow, it's almost a guarantee that this company is going to do it fantastic. So I know a lot of you have bought into them before and you're kind of worried about it. Well, look at it long term. Look at these percentage numbers. All it needs to do is get to $15. That's not 25 or 50. We're not talking about Microsoft or Amazon or anything. We're talking about small companies that just need to grow 50% over 5 years, and you're going to be making 100% to 420% returns. Ridiculous things like that. So guys, I hope you enjoyed it. I hope you learned something. I mean, I really think this is a great strategy. I've done this with Finance of America. I've done it with another company called Juniper Holdings, which makes self-storage doors. Another company people made fun of me for buying into, but it doesn't matter. It works. So Juniper Holdings actually has the redemption under $18. So that's why like it's not going to work perfectly. But as long as they don't call the warrants due, kept going up, right? And went to, what is it right now? Over $3. So that's another 100% gain. So guys, I hope you learned something. Let me know in the comments what you think. Like, do you think any of them are good? Are you going to look into the strategy? Do you find other ones I didn't cover here? Let me know, and I'll see you guys in the next video.